Hello, fellow value investors. So earnings season is winding down, but 13F season is here. So every quarter, the investors who control the largest funds, those controlling funds of, I think, like $150 million or more, they have to report their holdings publicly. And you can tell from the change in their holdings what they've been buying and what they've been selling. So we're going to take a look at these now. Two things worth noting. One, this is a combined list of what they're all buying. So blue chip mega cap stocks are going to be overrepresented. They have the most attention on them. Obviously, the thing that most of them bought are going to be stocks that most people are looking at that have big market caps that aren't going to be moved by most of them buying them. The other thing to keep in mind is that these are what they were buying last quarter. And on top of that, there's a 45-day delay between when they report and when you see it. So this is what they were buying between, I think, 135 and 45 days ago. These are not what they're buying right now. Also, just don't buy these because they're buying them. But I think it's good to kind of check your work against these people. If you're coming to a lot of the same conclusions as they are, it's a good for like the internal report card. It can put you on to new ideas and it can give you confidence in things you're almost at the line of pulling the trigger on, to know that a bunch of other people also have decided to pull the trigger on. I see two in here that I've been looking at and considering buying, and I haven't. I see two in here I haven't even looked at before. Those two I'm going to go do some research off camera on. But what we're going to do once we've done all this is we are going to put them in a tier list. The last two lists did well, and I think it's actually a pretty good way to analyze these. So I think the first one we want to look at is Microsoft. I didn't even put a D tier on this because there's not going to be any D tier or F tier stocks in here. But if we take a look at Microsoft, my opinion on Microsoft is it is now fairly valued. I was telling people to buy it just a few weeks ago, and it's run up about 25%. I don't know if I can zoom out and you can see it's gone up massively. I was telling people to buy Microsoft here. Now I think it's fairly valued. And you can see by this future cash flow here that the consensus of analysts, this is 53 analyst future cash flows combined together. They say it's about fair value right now. If we look at the analyst price targets, they also say it's about 11% undervalued. And my feeling is it is about 10% undervalued to fairly valued. I don't think that's enough margin of safety for Microsoft. I think that there are better buys on the market. Let's take a look here. And I like to look at everything except the current valuation before getting too into whether, like, I don't want to know what valuation metrics other people are paying. I want to look through this and decide what valuation metrics I feel is fair and what I'd pay, and then we'll see what it's going for. Microsoft is one I've already looked at because I hold it. And I currently am holding, not selling, not buying, just holding. If it goes to like 550, 600, I'll start trimming and selling. So anyway, past performance, we're getting 14% earnings growth. We're getting 13% revenue growth. If we look at the future predictions, 14% earnings growth, 15% revenue growth. So we can call it a 13 or 14% growth. If we look at the shareholder yield, you're getting about 1.2% shareholder yield. So we can bump that up onto the growth, say that you're going to get an extra 1% return. So now we're talking 14 or 15%. So let's just say 15% if we're going with like a Bogle valuation of shareholder yield plus growth. And I'm not going to worry too much about valuation expansion, right? So multiple expansion. If we look at financial health, they're in a pretty good position. They're actually reducing their debt to equity, which is good. A lot of these hyperscalers, they're taking on a lot of debt recently. Another thing to look at and worry about with all of these, we're going to look at free cash flow versus cash from operations. So the cash from operations is the free cash flow with the Capex added back in. And on some of these companies, I do like to go on cash from operations, but it's worth noting here that they are diverging massively. Cash from operations is going way up, but free cash flow is flat to down. And that whole gap is their capital expenditures on this AI build out. So I do think Microsoft's getting the worst returns out of the hyperscalers on this. Their cloud segment is growing the least when you compare it to Google and Amazon, who are having like mind-blowing growth numbers. Azure's just having like pretty good growth numbers. I'd have to look at the report. I feel like it's like 30 or 40%, where the other guy's getting like 60 to 80% year-over-year growth. I think Microsoft's management is not as tech savvy. I think they're much more business savvy. I think they blunder a lot of things. I've used their products and I don't like how they manage most of them, but they do have a great moat. So considering all of that, I think fair value for Microsoft with this kind of 15% growth number, I would like it a little under a peg, using Bogle's valuation as the growth of 2. And I would say that like 28 to 30 PE is fair value. If you can get under that, that begins to be your margin of safety. So if you could say buy in at like 23, I would think that that's a lot of margin of safety, right? 25, we're not quite there, but 28 to 30 is, I would say, fair value. And if we go and look at their PE, 27.5. So I don't think there's enough margin of safety here. I think it was a good buy when these people were buying it, but right now I think it's a C tier. 45 to 135 days ago, it was a great buy. Now it's just a fair value buy. And I don't even think it's the greatest company. I think a lot of the other Mag 7 are better companies. I think buying Google or Amazon at fair value is more attractive than buying Microsoft at fair value. So on to the next stock, Meta. So Meta is, on my gut instinct, a worse company than Microsoft. I think Meta is the worst Mag 7 other than Tesla. To me, I barely even count Tesla as a Mag 7 because I despise it so much as a value investor and as someone who knows some things about science and engineering and knows the guy's full of shit. But Meta is not great. Their issue is that they are not diversified at all. They have their ad business. Every time they try to do something other than the ad business, they face plant. I do think that this AI play, though, I do think it has a good chance of working out, and I think it is priced at a level where even if their AI play doesn't work out, I think that there's still money to be made just from the ad business. I think it is priced to the point where just the ad business is worth it because it's being dragged down by all this capex. Even if the AI play does not work out, I think that they still have the option to become like a neo cloud or hyperscaler, depending how you look at it. I don't think they could be quite that hyperscaler level, but they can use these data centers and rent them out. And they claim that there's plenty of demand and that would be profitable. It seems like all the other companies that are building data centers are getting profit out of them. So I think that Meta is priced with a lot of margin of safety right now. I think it's priced right now like the AI thing totally face plants and you're just buying the ad business. But let's take a look and see what we see in Simply Wall Street when we go look at it. So we are seeing by future cash flow value, 37% undervalued. When we take a look at the analyst consensus target, we see 22% undervalued. So once again, significant margin of safety, it has to be basically 20% to 40% worse than current expectations for you to not make your money back. So let's go take a look at Meta's growth numbers to start. So we immediately see better growth than we were seeing with Microsoft. So I see 18% earnings growth. I see 15% revenue growth. If we look at the future, the prediction is 14 and 16. So if we're going to look at those numbers, and the reason I don't use EPS growth, by the way, is because it can double count the buybacks, right? And I don't want to do that. So anyway, if we look at both of these, I think 15 or 16 is once again pretty fair, a pretty fair conservative midpoint. We can take a look at the dividends. We're getting 1.4 and 0.4, so almost 2%. I think we can fairly add that in and call it like 17% growth. So off of my knowledge of the quality of Meta, I would want a lower peg than I would get for Microsoft. Let me actually pull a calculator up. So we're talking 17%, and I would want a peg of more like 1.5, where Microsoft might want 1.8. So I would call 25.5 PE fair value. If you get them at 20 PE, that would be like a 20% margin of safety. But let's go look at some other things first. The financial health. See, here you can see they are taking on debt for this AI build out. Can I ask this AI, what is the cost of debt? Just get an idea of what kind of interest rates they're paying for this debt that they're taking out. If they're getting good interest rates, and we can compare that to the return on assets, so the cost of their debt is about 3.2%. That's great. That's like below what the U.S. government's paying for its debt. So if they're getting that number and we go look at their return on assets, return on equity rate, return on assets 15%. I think it's fine for them to take out 3% loans when they're already getting 15% returns on their assets. That should be a 12% spread, theoretically. Now, say the AI thing doesn't play out. This number could go down to 7 or 8%. That would still be worth it, right? Maybe the AI is negative returns. In that case, the specific thing they spent it on had negative returns, and it was not good, right? But in general, them taking on debt at 3% when they get a 15% return on the cash that they borrow, it's generally pretty good. So once again, I would say like 26-ish, 25-ish. That seems to be about fair value. So let's go take a look at their valuation. 22. So that's giving you like a 15 or so margin of safety. If we look at their forward PE, we're talking 18x. So if you want to value it on their forward PE, then you are getting more towards that 30 or 40% margin of safety. With fast growing stocks, I do think forward PE is a pretty good metric. In theory, if you knew the real forward PE for every stock and not just analyst estimates, you would be the best investor in the world. If you looked at every stock and knew its real forward PE, you would be making bank. So getting the best guess from a bunch of really smart people who studied these companies is, I think, fairly useful. Some people don't like forward PE because it's not a real metric. I think that there's some value to it. I think buying Meta at a forward PE in the teens is a good buy. I think that a lot would have to go wrong to not justify this price. So going back to the tier list, I think Meta's an A or an S tier, honestly, and I think I'm considering buying more Meta. I mentioned last time I was considering buying more Meta. I put it on my stocks to buy. I think I'm down to increase my position on Meta. None of this is, of course, financial advice for you, just what I'm doing and what I think, and I've only been investing for a couple years. But I think for the time being, I will put Meta in the S tier. I think you're going to see Meta in the list next quarter of stocks that Superinvestors are buying. And I think one of these days, I think within the next 2 years, Meta will have market beating returns if you hold the stock for 2 or 3 years. That's what I believe. So on to Visa, a stock I do not own. So personally, I'm a Mastercard holder, not a Visa holder in my portfolio. And they are both about equivalently undervalued. We're going to look side by side and see. But the reason for me is that there are some threats to the moats of these companies, and that's stablecoin, and that's the European Union and China, all them. They're trying to move away from the American financial system. I think they'll be able to defend their moats, but either way, I do see some threats to the side that Visa has more exposure to. Mastercard has more exposure to credit cards and kind of premium credit cards at that, where Visa has more exposure to like debit cards, gift cards, and some more entry level credit cards. I can see people replacing their debit cards. I can see the gift card system maybe someday getting replaced with some stablecoin based thing or something. The credit cards, I see having a much stronger moat between people getting their points, between people being able to spend money that they don't have, people being able to float their spend for a bit over a month. You know, people can spend something they don't actually owe it until a bit later. I think those things are things stablecoin can offer. So I picked the company that had more exposure to credit cards, which I'm more certain are going to exist and be popular years out, where debit cards, especially when AI agents start doing your purchases for you maybe one day, they're going to look for whatever gets sort of the transaction fees. I think that the transaction fees really comes at the moat of debit cards. If you're just spending money that you have access to on the spot, why pay the transaction fee if you can do stablecoin, right? So let's take a look at these side by side. Okay, so here we have side by side Mastercard and Visa. Mastercard on the right, Visa on the left. Now I'm going to hide my camera real quick just so we can look at these. According to analyst consensus target, Mastercard is a little more undervalued. And if we go look at free cash flow, which I'm not convinced is the greatest metric for these, it's putting Mastercard way undervalued. I don't know if I trust this exactly. I wouldn't put too much in this. Let me take a look at where they're getting this number from. This between 38 analysts, where the other one is from 37 analysts. I'm not sure where this massive gap is coming from. I'm going to mentally discard that. It seems like an oddity more than anything. So let's take a look at these. Let's look at the past history on these. For Visa, you get 12% earnings growth. For Mastercard, you get a 12.5 and 13.8 actually. So more, you could round those up 13 and 14. On revenue growth in the past, you get 11.8 versus 13.5. So Mastercard's winning on both of those. If we look at the future forecast on both of these, Visa has a slightly higher forecast on earnings growth, 11.8 versus 11.1. And if we look at revenue growth, MasterCard is forecast to be a little higher, 9.7 versus 10.8. They both have absurd return on equity. Let's take a look at the health of both of these companies. Yeah, the debt to equity ratio on MasterCard is much more of a mess. So yeah, the debt to equity on MasterCard is a bit of a mess. I would have to look into this further and figure out what this is. We can look down here and we see they both have about 24 billion in debt. Anyway, we'll come back to that. But if we want to look at these numbers here and come up with a good growth rate, I think this is like 12-ish, 11-ish. Here we're getting like 13. And so this is like 11. Let's call it 12 for both of them. Let's say they're both growing at 12%. If we look at the dividend, they're both doing about a 4% shareholder yield. So we can call that like 16% in Bogle's valuation. I think that they are both very heavy moat companies. So we could say that 13, 4, 17%. I think a PE of almost 2. I think that honestly 30 PE wouldn't be unfair for either of these. So we can call 30 PE the fair value on both of them, I think. They're both so similar. They're both at about 30 PE. If you want to judge them on forward PE as fast growers, you do get some more margin of safety. I'm sure that they're at historically low PEs. Can I see that here? Yeah, price to earnings historically, they trade more in the 33, 35, 36, sometimes 40. If we look at the valuation here, Visa's a little higher. So normally Visa trades a little cheaper is what it looks like. Right now, 30 versus 29.8. Almost identical companies, really. And that's why I've gone with MasterCard. I think I bought a little lower. I might add a little, but right now I'm happy to sit on it. I'm up a little on MasterCard. I'm up like 67%. I don't know if I would buy at these prices. I was probably buying down more near this 28 number. It is a very high quality company. They are like buy and hold forever type companies. I don't think you need a massive margin of safety to buy these, but I also don't think you have one. I think, in my opinion, it was probably overpriced. There was a lot of certainty priced in before, I would say, and some of that certainty has now gone away because there are some real threats to the business. So let's go back to the tier list. I think Visa, I'm going to put at a B. MasterCard, I would have low A or high B. I think Visa's like middle of B. I think it's a great company. It's a great company at just a fair price right now. And there are some threats that are giving it that price. Amazon, I think I've already talked about Amazon plenty, and I think it's going to be an A, but let's go take a look at its numbers right now. I think it would have been an S before its 30% jump. Now it's maybe bottom of A, top of B, but let's take a look at its numbers. So let's take a look at Amazon now. If we look at their fair value, they are 20% below the analyst consensus target for their fair value. And on a future cash flow between 60 analysts, they are 39% undervalued right now. Personally, I like to value Amazon closer to operating cash flow. I like to include the Capex. I very much like that they don't really care about net earnings or free cash flow. They like to reinvest as much money as they can find a good place to reinvest it, and they've always found good places to reinvest it. On top of that, I consider Amazon a very high quality company. I think it has one of the best moats in the world. It's one of the companies I am most sure will be here 20 or 30 years down the line, and it will have grown at a significant rate between then. I am very, very confident in Amazon's ability to outperform the market, even if you buy it at a fair value. So you can get it at below fair value and just hold a long time. I love the business. I love the way that they are so diversified. They're so good at getting into new areas, and then burning cash to outcompete everyone and establishing a monopoly almost on anything they want. They're great at just destroying the competition. It's not maybe great for people, but they do make people happy to be Amazon customers. They do offer a lot of value. They do pass on a lot of their economy of scale to their consumers. Anyway, if we look here, 41% earnings growth, 10 or 11% revenue growth in the past. They, as far as I know, they have a long history of beating. So the future forecast, it's probably going to be a little higher. But this 41% number, I think we can discard. That's probably margin expansion, right? And they can't expand the margin infinitely. If you look at the future forecast, 12.5% revenue growth, 7% earnings growth. So I think we can call 12.5 is, I think, a relatively good number to use. So if we look at their shareholder yield, there's no shareholder yield for Amazon. If we look at their financial health, they are like some of these other hyperscalers taking on debt for the first time. They did recently spike up, and it is still increasing, but because their equity has gone up so much, likely, and this is probably also part of the earnings weirdness, it's because they had those investments in, was it SpaceX or Anthropic or whatever. So that's probably part of the equity spiking up. But anyway, their debt to equity is actually down over the last quarter, even though they took on more debts from 29 to 25%. Their debt is at like a 2.8% interest rate, I believe. I asked here. Their debt's at a 2.8% interest rate. They are earning 12.5%, 12.5% return on assets. So if we look at their past performance, it wants to return on equity 25%, return on assets 12%. Great for an asset-heavy company. Their free cash flow is actually negative, but as I said, I'm more interested in the cash flow from operations. Now, I said they're growing at 12.5%, and I think they're one of the highest quality companies in the world, so I would go up to a PEG of 2. Operating cash flow might not be the best, but if we want to look at their earnings, the earnings is actually near the cash flow, but that's also partially because there's the unrealized investment gains, right? But let's look at this cash flow from operation number. It's actually above the earnings. We could go off earnings. It's not that unfair. But if we take a look at this, let me get my calculator. Sorry, here. So if we get the calculator and we take this number, sorry, I keep forgetting where my mouse is. Okay, so their market cap is 2.8 trillion, right? And if we divide that by, sorry, where divide? Okay, it's waiting for me to put it in. 161,403 billion. We get a price to operating cash flow of 17. So that's closer to like 1.4 price to operating cash flow growth. If we used their earnings, it's hard to pick an earnings number because there's the investment gain. We could call the earnings 100 billion maybe, and then we're going to end up at a 28. It's a definitely harder to value. The ideal metric would be owner's earnings, but that's very hard to calculate, and that involves splitting up the growth capex and the maintenance capex. You punish them for the maintenance capex and you take it out. You do not punish them for the growth capex and keep that in. And a lot of this is growth capex, this negative cash flow, right? So it's hard to value, but I would say that if 25 is fair value, we could even trim it back and say like 20 or 22, just because this is a weird metric. You are still getting a 15 to 25% margin of safety, I would say, up to even a 40% margin of safety, right? And that's probably why the cash flow models show 40%. On a company that I don't think you need any margin of safety to buy. So if we go back to the tier list, I think I'm actually going to bump Amazon up to an S after looking through all that. I wasn't sure it was top of A or bottom of S. I think it's an S even after the 30% runoff. It's one of my biggest positions. I was loading up on it before before the earnings, before it jumped up, and I might still add to it. I think it's still a great company, and I think the price is still pretty good. I think they're going to be an AI winner, and I think they have a ton of places to deploy AI, and I also think that they're going to be a huge robotics winner. I think that they're in the lead in robotics, really, and robotics is going to become the next big thing. AI in bodies is going to become the next big thing. Let me hide this. Okay, so on to Berkshire Hathaway, a classic for value investors. So Berkshire, it's a really weird one to value. For some reason, there aren't a lot of analysts. There's not a lot of analyst coverage on Simply Wall Street for it. So there are only 4 analysts. They have it at 35% undervalued by cash flow and 6% undervalued just by the analyst fair price target. It's once a weird one to value. They definitely prefer to be valued on price to book over price to earnings. Their earnings can vary wildly year to year from investment gains. Fundamentally, it's a collection of very, very safe companies in a very decentralized organization structure. They just buy good companies and let them run themselves for the most part. And the companies can kind of support each other, feed them cash. They can use the cash to invest. They've recently begun buybacks, which one implies that they think that the stock's cheap. And two, I think Berkshire Hathaway has been running, it's something I've been thinking about. They've been running into issues of they're too big to grow like they used to. And one possible solution to that would be to return a bunch of money to shareholders and shrink. I've been reading the old Buffett letters, and he really drills home that if they're not beating the market, then you should take your money out, right? And Berkshire Hathaway has not been beating the market for a long time. It comes close, but he talks a lot about cash as a commodity and what they do to try to make cash not a commodity. And in another sense, the stock's a commodity, and they try to make their stock not a commodity, make their stock worth a little more than everyone else's. If their stock's growing 10% or 8%, let's say, and everything else is growing 10, that you might still be willing to forego that for the safety of their stock. They talk about in their insurance how the confidence that they'll have the money when disaster strikes means that it's not just a race to the bottom for them, and they can offer worse deals than other insurance companies and still get the deal because if the contract's big enough, people know Berkshire will be there. In the same sense, if the market crashes, Berkshire will be there, that they have a lot of very fundamentally sound businesses. I'm not convinced by Greg Abel's investment style yet. It remains to be seen. He's going to be leaving less money on the table, but he is taking on more risk in exchange for that. They are exposing themselves to tech like they haven't before. They're refocusing the portfolio. They're doing buybacks, but I do think that people are scared because of Buffett being gone, and he designed the whole thing to not need him. So they're at a price to book of 1.4, and let's look at the past. This is what I'm not really going to be looking at, the future and past growth. It's almost meaningless. No, I don't want versus peers. This is what I want. Price to book. So if we look at historically, price to book 1.3 to 1.4. Sometimes they go up even to 1.8. When was this? This would have been during the tariffs. I assume everyone flooded into Berkshire. This might have been during COVID, and it's part of why I like Berkshire. It's nice to have an asset that I know when the market crashes, it won't go down. It may even go up when the market crashes. And I'm ready to deploy that capital. I've spoken about this a lot. So I think it's just a good fortress, right? There's a chance that they go back to market beating returns now that they're deploying their capital into things like Google. If we look at analyst forecasts, they're so weird. Yeah, negative 7% earnings growth, 4% revenue growth. These are almost meaningless. Theoretically, if I were to look at this, call this an amazing company, they're growing 7 or 8%. We'll call it 8%, then maybe 16 PE would be fair value. If you want to call it 1.5, then this 12 numbers fair value. I don't know what's up with the forward earnings. It's also weird. But if we're looking at price to book, they're at about an average price to book. I think it's a nice, safe place to put your money. I think it's diversified. It's like a good peace of mind. And personally, I like to have some chunk of my portfolio in Berkshire. And if the market crashes, I'm going to sell it. I don't expect market beating returns from this, but there is the possibility for market beating returns. I think I'll put it at the top of B. I do fundamentally like the company. They have a size issue. The buybacks, we'll see how the buybacks work out. If they end up returning value to shareholders or being value destructive, it's a very hard company to value. S&P Global. I don't own S&P Global, but I have been eyeing it. I've been looking at it. I've been reading about it, and I'm going to go read some more about it right now and get back to you guys about how I feel on it. Okay, so let's take a look at S&P Global. I just did a whole research session on S&P Global, and I've kind of come to the conclusion I think they still have a very strong moat. I think that they are still a great company. I think most of their businesses aren't really under an AI threat. The rating business, the reason people want S&P to rate their debt is because they want to be able to tell people if something goes wrong. Well, S&P told us that that was AAA debt or whatever, and that's very hard to compete with. People can't say, oh, some AI startup told us that was AAA debt. That's not something they can do. So that's not at risk. I don't think the index business is really at risk. People aren't going to switch off of the S&P 500 because some new AI company came up with their S&P 500 generated by an AI. I think that their data business, they guarantee the quality of the data. They've been gathering it for a long time. They have a lot of experience. I don't think that's necessarily under threat. And I think they'll be including AI. So about 80% of their business has like almost no AI threat. The 20% that does, they're going to be instituting AI, and they're going to be instituting AI in all of this, I'm sure. So it's not like a guaranteed thing that it'll be even under attack in the first place, or that the people who are attacking it, they're going to have an advantage and they're going to be using AI too. So I'm not even that worried about the other 20%. So if we look at the past growth, we get 10.5 earnings growth, 13.7 revenue growth. If we look at the future forecasts, we see 6.6 earnings growth, 3.5 revenue growth. So it's a bit weird. Are we going to use this 6.6 number, or are we going to be going off the past or the future? I think that part of this is because they're doing a spinoff of their mobile segment. That might be why the future earnings growth, future revenue growth are lower. So I don't know. We can kind of hold in our head the two different like numbers, 6.6 and a 6.5 and 10.5. Let's call it. So we can hold both of those in our head. They're doing about 5.5 in shareholder yield, and those are growing fast. We could even call it 6. So then we're looking at like 12 or 16% growth. I do think they're a really high quality company. And I think that we could say like, once again, like 1.8 PEG. So that's like 20 to 25 is their fair value realistically. Is maybe 20 to like 26, 28. So their fair value is somewhere in there, I would say. The financial health, this is a little weird for me. I would have to go look at what happened in 2022 for this. So let's look also at their like return on equity. I'm sure these numbers are going to be great because they're a pretty asset light business. They have very strong margins. Yeah, return on equity of 14%. It's actually below the industry. But anyway, if we take a look at this, we see 25. So it's near the upper end of the valuation. This is at best a good company or a great company at a fair price. I think there might be a tiny bit of margin of safety. I think if we look at the valuation, I'm sure this is the cheapest they've been in a while. Yeah, normally they're trading 50, 40. Because a lot of people, they're paying up for the moat. And I don't think the moat has deteriorated, but even now, 25, I think it's just now reaching fair value. So if you like love S&P Global and think it's a great company you've always wanted, this is a good price to grab it up. I don't think that there's some absurd margin of safety, especially the forward earnings is apparently about the same. Let me actually go and get another opinion on the forward earnings. Okay, so I see here on Yahoo Finance that it is about a 23 forward PE. So I don't think that that's like too much of a difference from the 25 I'm seeing here. So if we go back to our chart here, I think S&P Global, it's either top of B or bottom of A. If you go with the bigger assumptions, then it's A. If you go with the lesser assumptions, it's B. I'm not convinced at their growth rate. They probably, the growth of the company should outperform the market. I do believe that, I would say. Do I think at this price you're paying up a bit for it? Yeah. I think there's a chance of just market matching returns here. I think top of B tier is a good place for S&P Global with what I saw. If S&P Global ever got to like 22 or 20 PE, then I think that would push it up into A. It's very close if it got a little bit cheaper. Am I going to start building a position? I've been strongly considering it. This actually pushed me a little away. I do think it's a wonderful company. It's a good company to have in your portfolio, potentially a hold forever company. I just think it was way too expensive before. Now it's just fair valued. And I think a lot of people might be mistaking that for it used to be fair valued and now it's cheap. I'm not convinced of that. So on to Google, a company I know much better and hold in my portfolio. So Google, in my opinion, another wonderful company, a pretty solid hold forever company. I don't have it quite in the same tier as Amazon. I could imagine some sort of future 20 or 30 years from now where in some crazy scenario Google's been replaced. They don't have quite the same infrastructure as like an Amazon where they have their massive logistics network that's almost impossible to compete with, but they do still have their physical data centers. But a lot of their moat comes from like IP, it comes from the talent at the company. It does come from network effects too. There are some of their businesses that would be very hard to push into, but like they could be a victim of the SaaS apocalypse if AI ends up actually being that good that like one guy in his bedroom can make the new YouTube. It could maybe become an issue, but they have a massive economy of scale that makes it hard to compete with them on price for any of these things that involve, massive storage and distribution of data too. So in that sense, it is a little bit of like a digital Amazon as far as the digital logistics, right? So if we take a quick look, the future cash flow from 55 analysts, 22.5% undervalued. Consensus target between how many analysts is this? It doesn't tell me. 19.2% undervalued. Let me go and look at their past performance. So past performance, we see 23% or earnings growth, 12% revenue growth. So there's some margin expansion. There is also those unrealized capital gains, the same thing that Amazon kind of has going on. If you look at the past, flat earnings growth, 16% revenue growth. So I think we'll go off this revenue growth number. We can be conservative and say like 12 to 15%. Let's call it 13. We're going to call it 13%. We'll look at the dividend. It's flat, 0.3 dividend, negative 0.3 buyback. So we'll say 13% growth. I think Google is a very wide moat company, a wonderful company. And I would probably go as far as to say a peg, it looked like 1.8 or 2 is once again fair for the kind of company they are, in my opinion. So that puts you at like a 24 to 26 PE is fair value. Their PE, this is misleading. I would want their non-GAAP PE, forward PE 19.5. That's aggressive. Can I get like a non-GAAP PE? Let me see if this AI can get me that number. So the numbers I'm seeing are like 17, 16. It is possible Goog's actually very undervalued because I mean, in any scenario I look at it, Google is absolutely worth 17, 16 PE. Google might be a buy again. Maybe I should start loading up on it again here. That's actually surprising. I don't want. I didn't want my S tier to just be all Mag 7 companies, but if these are the real numbers, let me see here. Future growth. So if it's talking trailing 12 months, that's this, but it thinks that it's going to continue this one-time oddity. So let's look at this number. This is more like a 2-year forward PE. So it's earnings of 221, and let me pull up a calculator. So 422 million divided by 221242. 19 on the 2-year forward PE. So that's getting to be a little more conservative. Yeah, so I do think that the earnings are like kind of manipulated by one-time things right now. And it looks like that's going to continue in these forecasts, and that's why the forward PE is also high. And I don't want to go off of that totally. So I do think, let's look at cash from operations. That's kind of ready to go straight up. So this is also maybe Capex stuff. The Capex is going to be absurd, but they're expecting crazy results on the Capex. They are expecting like 50% data center year over year growth. They say they have the customers lined up. But if those customers go away, if OpenAI and Anthropic and all them that bubble ends up bursting, maybe they won't have customers for all these data centers they build. So I think that it's not as high a quality company as Amazon, in my opinion, but it's up there. The valuation is certainly a bit more confusing for me. I think they might just be top of A, but I do think I'll actually be adding to my Google position. I trimmed my Google position probably at very similar prices a year ago, and now it might be time to add to it at those same prices a year later. I did always regret trimming that position, 345. Yeah, I think that I'm going to put Google. I think it's going to be an A tier. The future earnings, there's not great visibility on them. I would say if you're looking at the forward and 2 year out, like they're manipulated a little right now. You can't go off free cash flow, cash from operation. Maybe we could do cash from operation. What does that give us? Let me take one last look here. If we look at cash from operation, 185, 675. So if we do okay, and then we divide that by 185, 675, 22. That's closer to what I was thinking as fair value. So if we're going to value similar to how I value Amazon on that cash from operation, I think, yeah, it's a little under fair value. I think that there's a bit of margin of safety, maybe 10%. And I think that's probably enough for Google. And I think that we'll keep that A tier. So Disney, like S&P Global, it's a stock that I've been looking at through the last quarter. I have not pulled the trigger on. I've been looking at it for a while, actually, at some of these lows. The thesis being that the company has doubled in size in the last 5 or 10 years, but the stock has remained flat. So there might be some repressed valuation expansion, some multiple expansion. There could be a profit margin reclamation. Part of what keeps me away is, one, the poor performance recently. Also, new management. New management's always a little sketchy. It always comes at the Moat. I don't know how good this new guy is. Berkshire has a little of that, but he's been in it forever, and Buffett's still there, right? But like Google, Amazon, Meta, they've had steady leadership forever. Microsoft, they are having a little bit of a reshuffle in some of their divisions, but like it's still fundamentally the same company. Disney has a very new vision stepping in, and I think it's a parks guy now, right? And I don't know exactly where he's going to be going with things. I do think that the Marvel movies and all that are great. Buffett always said about Disney that like Mickey Mouse is never going to go on strike for a pay raise. We can take a quick look at the future cash flow, 2%, consensus target 15% undervalued. And that's between 31 analysts. We'll take a look here. So I just want to make this point here that like the company, its revenue 10 years ago was 52 million. Its earnings was 8 million. Billion, 52 billion and 8 billion. It's now 98 billion in revenue, still 8 billion. The profit margin went from 16% to 8%. So all they need to do is reclaim some of their profit margin. You can see their profit margin was like negative in the middle here as they were spending money on Disney Plus and all this. They've been spending a lot of money on content for revenue growth. So let's take a look at future growth, 12.7% forecast, 4.5%. Past 38%, 6.7%. So there's definitely some margin reclamation in here. That's not something they can do forever. So maybe I'll call it 10%. That's a number I feel comfortable with because at the end of the day, it's going to fall back to these revenue growth numbers, but they definitely have some margin to reclaim. So we can give it 10%. If we look at the dividend, it's a pretty fat dividend. It is. It's 6% basically. So we're talking 16% growth. What kind of multiples would I pay for Disney? maybe 1.5. So that puts it at like 24. Let's take a look at the financial health, see if there's anything big. It looks healthy and going in the right direction. So let's look at the return on equity too. We can maybe like look at them from price to book. It depends on what it is. But if we look here, return on equity 8%. So I'm not sure actually. I would be valuing them at price to book because I would want basically a price to book of 1 if I was going for that. So let's see here, 21 PE. I said 24 is fair value. So there's like a 10% margin of safety. If you go off forward and the forward looks great, suddenly there's a very big margin of safety, almost 50%. Price to book 1.7. They actually are near there, but like if I'm saying I have to pay $1.70 for $1, and then that dollar gets 8% returns. It's not the most amazing, honestly. I do think that this is attractive. Can Disney remain at these multiples? I'm not sure. Can I look at the future? What do we see in the future? Free cash flow is about consistent with earnings. This is all Capex. Okay. It does seem like this trailing, there's some one-time stuff here or something. If they reclaim more margins, I think I would have to look at what this new guy is doing, but I think this is definitely attractive. And I think that it's possible that the stock could have some pop in it. I've been looking at it every time it goes under $100. It is right now over 100. Some of these guys were probably buying down here, right? I don't know if I'd exactly buy at this price. I think Disney is very interesting, though. I think there's some real chance of like very market beating returns here. I think it's a company that's going nowhere. Like if you put your money in Disney, it's not going to not exist in 20 years. You're not going to be poorer in 20 years, and you'll probably at least have inflation beating returns. I don't feel comfortable saying you'll have market beating returns though. So let's take a look at Capital One next. I'm going to have to do a little research. I understand the credit card business. I just want to know what kind of the breakdown of how they run it is, because that I do not know for Capital One. So before I move on to Capital One, I just want to say about Disney that if the price goes below that $100 mark, I would become a buyer. I think it moves towards the bottom of A tier instead of the top of B tier. But anyway, let's go take a look at Capital One. But anyway, I've now done a little research session on Capital One. It's essentially a bank, and they just acquired Discover, which is a processor kind of like Visa and Master Express, an actual credit card network where they've actually bought the rails. So it's kind of like a blend of like a JP Morgan and an American Express, where they're a smaller credit card network. They have a bank. They're a bit of a fintech. They have some physical locations, but they're also trying to expand through an app. They're trying to offer better rates. They aren't as leveraged as a lot of banks. They're also getting a slightly lower return on equity. This is likely because so much of their lending is in credit cards. That's higher risk, so they can't leverage up like the other banks that do much safer loans. It's going to be a very hard company to value because of just the nature of it. You'd have to do a sum of its parts valuation on Capital One. There is a chance to outperform, but because unlike Mastercard and Visa, they actually do lend the money for the credit cards, they're underwriting the loans. If there is a consumer debt crisis, which is something I am worried could be coming, they would take a big hit. So I would need a very large margin of safety. We'll look at the analyst targets and DCF. That's probably better than anything I could give you. And I will take a look and see what I see. But if we look at the DCF between 22 analysts, you get 33% undervalued. So a pretty large margin of safety. If you get their consensus target, you get an 11% margin of safety. 12% even. So there is some margin of safety. I think I might require more. If we look at the past growth, the earnings growth's negative, the revenue growth's 2.5. I'm going to assume this is from acquiring Discover. Well, I haven't read through the 10K. If I were to buy this company, I would actually read the 10K. I would do a sum of parts evaluation probably. I would separately value the bank, the fintech, the credit card lending, and then the credit card processing. add them together, add some like synergy multiplier to it, because these all do kind of fuel each other and boost each other up. But if we look at the future growth, you get 13%, 14%. I think we can use, I don't want to go quite that high. Obviously, this number's wrong. This number's weird. Maybe 8 to 10%. So let's go look at the dividend. The dividend, that is impressive. So if we go with an 8% growth rate, and they're doing 6% buyback, 1.4% dividend, we're talking 8 plus 7.5, 15.5% growth. I would say between what they pay you, what your share grows, and then what the company underlying it grows. Financial health, asset to equity ratio 6. This is low for a bank. The reason is because they're giving riskier and higher interest loans. From the Discover purchase, seems like they've actually gained some debt to equity. The sufficient allowances for bad loans, appropriate levels of assets. So it seems like they're running a pretty solid book. If there is a massive consumer credit crisis and people can't pay their loans back, though, it's going to be tough. So where would I value this? If we're going to value it as a bank, maybe a price to book of like 1.5-ish. I would say maybe a little higher, 1.6. I think from what I hear, the management's good, and he's the founder, and he's been doing very good. If we look at it on the 5-year, if you bought here, you'd be doing great. But if you bought here, you're nearly flat. You probably not had sufficient returns. If we go all the way back to when he founded it, he's turned it from $5 to 200. So it's like 40x in a little over 30 years. I don't think that's too amazing, actually, but it seems like he's been doing a pretty good job. You've had stable management the whole time. Things have been going generally up and to the right. You are buying kind of near the top here. If we're going to go with a price to earnings ratio, I don't think for a bank I want to give it some like crazy PEG. If we're giving it the Bogle's valuation, which is generous, we're giving them already like 13%. So let's call it like a PG of like 1.2, 1.4. And where does that get us? That gets us to like 16-ish PE, 1.5-ish price to book. So if we look here, 14 PE, 1.4 price to book. So it is relatively undervalued. From my fair value, it's like 10 or 15% under, right? I think that it could be an interesting buy. I do worry there's some extra risk here. You would need to risk adjust your returns, and that's what I did by lowering the PEG. I added kind of an extra like that's almost like increasing my discount rate. And I do think that there's some chance here. This might be, if I'm looking for a bank to get into, this could be a decent one. I'll consider this. I am happy with my credit card processor. I think this could be an A tier. I think that there's some good chance of market-beating returns there if things go well, but I think that there's, like Google, a chance, and I think it's a much bigger chance with Google that things don't go well. But I do think you're buying, it looks like a good bank at a good price, really, and looking at those numbers, I can see why these super investors are getting in on it. I also think that becoming a credit card processor is great for them. I think the Discover acquisition, I haven't actually looked at the price they paid and the value they got, but fundamentally acquiring Discover is very good for the business, and it seems like their financials improved. Their price to book got better after the purchase. So Thermo Fisher, this is a company I know nothing about, and I'm about to go off and do another whole research session. Okay, so I just finished up a little deep dive on Thermo Fisher, and as far as I can tell, they make scientific equipment for all sorts of companies. It might be something that's outside of my circle of competence, but they're not necessarily engaging in the biopharma or any of this. They're selling the tools. They're almost selling the picks and shovels here. From what I've seen from looking through the reports, about 10% growth seems very consistent over time. They had a big boost during the pandemic, and they're unwinding now. So negative growth rate, 2% revenue growth rate, forward-looking 10%, 5%. I'm comfortable using the 10% number. Like I said, it seems like there was a bit of a bump from the pandemic. But even if we look at this 10% number, we add in this 2.5, we're at 12.5%. Even calling them like the strongest moat company in the world, the most reliable compounder ever, and they are a reliable compounder. They're probably going to reliably compound 8 or 10%. Um, I could still only say 25 PE, maybe, probably 20. If they were in the teens, I would look at this as a buy. They were lower before. Maybe that's when people were buying. But I mean, if we look here at the valuation, 31, 27 forward, to me that's not good enough. Price to book of 4 and a return on equity of, where are we? 13. So you need $4 to get $1 if they're booking. They're compounding it at 13%. So you're really getting like 4-ish% return on like your equity buying at this price. We can go look at what the analysts are saying. Future cash flow is 7% undervalued. Analysts consensus target fairly valued. So maybe if we, I mean, maybe looking at this down here or whatever, let's see, 3 months. So they would have been buying at lower prices. Maybe they were buying in here. This is around when they would have been buying. Maybe they loaded up under 500 and it makes sense, but this is now shot up, and it certainly makes no sense now. I'm not sure what it would have been. Maybe it was more like 25 PE back there, but I cannot justify a 30 PE for this company. Free cash flow, maybe there's some weird cash flow stuff, but no, the cash flow looks the same as the earnings. I don't see it. This is possibly even a D tier. This is a company that I would say is overvalued. If I had a D tier, I might put it there. Maybe they got a really good price, but right now I don't see it. It's outside of my circle of competence. They're not growing that fast, and to justify this valuation, I would say no way. If they were ever below 25, if they were 20, maybe I'd take a look. 20 would even look a little expensive to me. I would want them at 18 or 16 maybe, just because they're so far outside my circle of competence. Now, perhaps there's a chance that because they're selling the picks and shovels and there's this like AI biopharma thing coming up where AI can create genetic code and can create proteins and can create new viruses and bacteria to do specific tasks, that maybe someday everyone's going to need Thermo Fisher tools. Maybe Thermo Fisher is going to be like the next NVIDIA of the AI. They're going to be a supply chain bottleneck. That could be what people are betting on. I suspect people were just buying it 12 or 15% lower. It seems like a lot to me. I just can't square the circle on saying this company's a buy. And I don't know a whole lot about it. I'm not the most expert opinion, but it's so far above an attractive price to me that I'm not going to look too much deeper into it. So thank you guys for watching. This is my final tier list. We have Meta and Amazon in the A tier, two undervalued companies growing like crazy. In the A tier, we have Google and Capital One. Google, a fast-growing company that's fairly expensive. Capital One, a strong company growing at a respectable rate and a fairly cheap price. In the B tier, we have Disney, which has chances of margin expansion. They've grown a lot, but their stock hasn't kept up. S&P Global, rock solid Moat, but I do think is relatively fairly priced at the moment. Berkshire Hathaway, just a financial fortress with some interesting prospects in the future. Visa, payment processor, once again, strong Moat, strong compounder, but I think a little more at threat than Mastercard. I think Mastercard might also be in the A tier for me. In the C tier, we have Microsoft, another one of these great growing hyperscalers, but I don't think as well managed as Meta, Google, Amazon, and much more expensive, now fairly valued or a little under. Not enough margin of safety for the quality of the company. Meta, I would say, is probably a worse company, but has a massive margin of safety. And then finally, at the bottom, Thermo Fisher Scientific. This is just an average-looking company, a pick and shovel seller, but not growing amazingly fast, and at a very, I think it was the most expensive company we looked at today, and also one of the slowest growing. So I cannot put any sort of stamp of approval on Thermo Fisher. I would probably put it in the D tier if I had one. Thank you guys for watching. If you made it this far, that's amazing. Comment what you think of my analysis on some of these. Some of these stocks I was almost looking at for the first time today, Capital One and Thermo Fisher. If I'm wrong about Thermo Fisher, if there's something I don't understand, please tell me. I'm very open to changing my opinion on it. If there's any videos you'd like to see, let me know. I'm going to try and get another video done this weekend and probably post it during the week. I'm going to try and get this one posted today. I had a busy week. I had a one-day weekend, so I could only get out one video this week. The last video did great, and I appreciate all the love it's getting. Thank you, anyone who watched this far. Like, subscribe, comment. All those things help it out in the algorithm. And thank you for watching again. Have a great day.